Opinions expressed herein are subject to change and not necessarily the opinion of the firm. Past performance is no guarantee of future results. The information presented herein is for informational purposes only and is not intended to provide personal investment advice. It is important that you consider your tolerance for risk and investment goals when making investment decisions. Investing in securities does involve risk and the potential of losing money. The material does not constitute research, investment advice, or trade recommendations.
And now introducing Mr. Keith Lanton.
Good morning again. October 28th, last week of October. Going to get started. Lot to talk about. Hope everyone had a fantastic weekend. Almost into the month of November. In fact, I believe on Friday we will be at November 1st. Also, happy Halloween to everyone. So a lot to talk about, a lot going on in the world, lots of things to think about as investors position their portfolios that are appropriate for them, given everything that's taken place in the financial marketplace. So I want to get started this morning. Going to talk about not the middle, not the beginning, I should say, but sort of midpoints and the end, and how individuals, both as investors and in their lives, think about whether it's conscious or unconscious. Think about midpoints, and also how people behave when it comes to when they're closing in on something or the end, whether it's the end of their lives or the end of a project. And these are interesting observations that number one, investors can use as they think about making investment decisions, and as advisors can use as they are offering advice to potential clients, whether it's in the financial services field or in any other aspect where advice is being given. What's interesting is that midpoints can teach us various things about human behavior, but they can also teach us about motivation, and oftentimes we think of a midpoint as almost like a smiley face. We're up in the beginning, and we hit that midpoint and that smiley face, and we kind of feel a little bit down, or not as up, or not as enthused as we did at the beginning. And then at the end, we tend to rally and think more optimistically. And that smiley face is a good metaphor in terms of midpoints, in terms of what actually has been observed by psychologists and sociologists. So when people look at their entire lives, and people are asked questions about how they feel throughout their entire lives, it's interesting that happiness tends to peak somewhere between 18 and 21, and that sounds fairly rational. It's a time after going through the adolescent or teen years, and suddenly you're almost an adult. Your body feels great, and 18 or 21 is typically a peak period in lots of people's lives. And what's interesting is, as people are asked how they feel about their lives, as they go from 18 to about 53, which perhaps is optimistic for myself at 52, there is a slow, steady decline in how people perceive their lives and their happiness. And what's interesting is that as they age, as they approach perhaps the end of their lives, happiness tends to increase significantly, picking up and surpassing the happiness level that people report at age 18 to 21, when people are about 70. And that happiness continues on even into the well into the 80s, and exceeds the happiness that people feel when they are younger. So something to just be cognizant of, both of yourself as well as others. And it's an interesting behavior, and why perhaps there's some sagging in the middle. One report is another observation about the middle, and people perhaps feeling that they're sort of stuck, trapped, perhaps not where they want to be. But interesting to note that when people are observed doing projects, or people are observed in interactions. What happens in the middle is the most corners are cut in the middle of a project than at the beginning or the end. So if someone is supervising a project or somebody is working through with a client on a host of issues, something that's an extended project, the attention span and the likelihood of focus tends to go down at the middle. Interesting observation for those who light candles for religious ceremonies. For example, one example here is the Jewish holiday of Hanukkah. What is observed is that in the beginning of the celebration, most people light their Hanukkah lights at the first and second nights, and as the holiday goes on, it's an 8-day event. Every day up until the 4th, 5th, and 6th day, participation declines, and then in the 7th and 8th day, participation literally reignites, demonstrating how people feel about midpoints and the beginning and the end. Now, midpoints are both a fact of life and a force of nature, but that doesn't make their effects inexorable. The best hope for turning a slump into a spark involves 3 steps. Number 1, as I mentioned, be aware of midpoints. Number 2, use them to wake up rather than roll over. And number 3, at the midpoint, imagine that you're behind, but only by a little, and that often will spark motivation and perhaps help you to move forward. Other factors to avoid that slump at the midpoint is when you're setting goals, don't just set goals for the end point, but set interim goals so you can see how you're doing, so you can have that rally up until the midpoint. The comedian and writer Jerry Seinfeld, acutely aware of midpoints, and what he says is what he does when he's being creative and working on a project or working on a new routine for comedy, is he makes a habit of writing every single day, even if he says he doesn't feel the inspiration. But he says he writes every damn day when he's working on something, so he doesn't have that lull in the middle there. I was going to talk about endpoints, but I think I'll save that for next week, since we spent a good amount of time on the middle. So what I'm going to do is I am going to move on this morning to talk about where we are here as we approach year end, as we are in the final quarter of the year, and hopefully give you some insights and thoughts both on what's going on this morning, as well as some more broad stroke macro thoughts, perhaps where we are in the evolution here of relations between the U.S. and China, or even the Eastern economies and our traditional allies in Europe, and the kind of the inflection points that we're hitting here in the United States. So as we approach this morning, October 28th, just looking back at last week. Last week we had S&P closing in on all-time highs. Also, the Dow closing in on all-time highs. Nasdaq as well. So we see the S&P up last week, up about 1.2%. The Dow up 0.7%. The Nasdaq up 1.9%. Year to date, S&P's up a little over 22%. Dow just off of 18%. Nasdaq up 25%. So strong year, obviously. Looking at the bond market, we are seeing weakness in the bond market last week. We're seeing weakness across the yield curve last week. Interestingly, munis outperformed. The 10-year Treasury was down about 0.4% in price last week. Muni price is down about 0.14%, so about 1/3 of the magnitude of the 10-year Treasury. But munis had lagged during the rallies that had taken place in Treasuries prior to last week. S&P futures right now are about 8.5 points above fair value. Nasdaq futures are up about 30. Dow futures up about 90. We are seeing weakness again in Treasuries. 10-year yield is up to a 184. The 30-year is at 232. So Treasury weakness is continuing this morning as we see some positive signs economically, leading some to believe that some of the quantitative easing and the lower interest rates perhaps won't persist as long as originally anticipated. We are seeing the upward move in futures this morning as trade sentiment remains relatively upbeat. Investors continue to monitor the incoming earnings, which in general have been viewed favorably, and we're getting updates on Brexit. We had the European Union granting an extension till January 31st for the British, and markets viewing that as a positive that was uncertain as well. In news, we see AT&T having earnings this morning. It's up slightly. On those earnings, they missed on revenues, but said that next year's earnings should be a little better than the street anticipated. Also, AT&T bowed to pressure from actor investor Elliott. They gave them some board seats. The CEO is going to stay on through 2020, and they said they're going to sell off up to $10 billion worth of non-core businesses next year. So we'll see if that news, which hit a little after 8:30, is a further catalyst for AT&T. In the earnings, they did see weakness in cable subscribers, in particular their satellite television business remaining weak and losing subscribers. Dow component Walgreens Boots Alliance (WBA), the pharmacy chain, up in pre-market action this morning after it beat earnings estimates. Looking ahead this week, we see the biggest events, including Google's earnings after the close today, Apple and Facebook after Wednesday's close. Wednesday, we get the FOMC's rate decision. Expectations are for a quarter-point rate cut. I believe that the futures markets are pricing in a little over a 93% probability for that rate cut. The employment situation report is also coming out for October on Friday. Docket also includes the Conference Board's Consumer Confidence Index for October on Tuesday. The first estimate for third quarter GDP on Wednesday. Personal income and spending for September is on Thursday. So lots of economic news, Fed decision, earnings. So this will be a week with lots of information and lots of potential gyrations in the market based on that news flow. Oil this morning down slightly to about $56. That's West Texas Intermediate a barrel. Also reports that Microsoft trading up about 2.6%, almost 4 points, after being awarded a $10 billion Department of Defense cloud computing contract. There was some talk that Amazon was going to be awarded that contract, some talk that the Trump administration, not happy with Amazon founder Jeff Bezos, encouraged a revisitation of that, and Microsoft subsequently getting awarded that contract. Tiffany's this morning up $28 to about $126 per share. LVMH has confirmed that they held preliminary discussions regarding a possible transaction with Tiffany. Also, this morning, if you're looking at the Asian markets, the Hang Seng up about 0.8%, China up almost 1%, Japan up 0.3%. This is this strength reflection of investor sentiment being boosted by a report out of the Chinese press that the U.S. and China have made progress on the text of a Phase 1 trade agreement, overshadowing some weaker economic reports that had come out of China. Also, in Asia, the Bank of Japan has a policy decision at their October 31st meeting date, which will follow directly on the heels of the FOMC meeting on the 29th and 30th. European markets not showing a lot of vigor to start the week, although that there has been some positive mood surrounding Brexit discussions and the U.S.-China deal. But markets in Europe trading mixed. The DAX trading higher by 0.4%. The FTSE in Britain relatively unchanged. and the French market and the Italian markets both up very slightly this morning. So I mentioned this is the week of Halloween, and just a sort of anecdotal trivia here that Halloween, October 31st, is one of the days of the greatest and most consistent strength in financial markets, specifically equity markets. On average, on Halloween, the S&P rises 0.19%, the Dow rises 0.15%, and the Nasdaq gains 0.4%. And the Russell 2000 on average gains 0.65%. Now that may not sound so overwhelming, but on average, gains of a fraction of a percent, which is much more minimal than that, is the average on a typical day. And in general, gains are a coin flip on any given day, although stocks tend to rise over time. But relatively speaking, the results that Halloween demonstrates are quite impressive. No one knows the reason why. We'll see if the typical Halloween rally holds up, but it is traditionally been one of the strongest days of the year, October 31st. Moving on to Barron's, a couple of interesting articles. There was an interview with Ian Bremmer, considered one of the sort of the leading thinkers in terms of macro or global thinking. He is the founder of the Eurasia Group, and is often called upon for his insights, specifically really the Eurasia Group's insights into macro events, both geopolitical as well as economic, and thought, given his knowledge, thought that his opinions were of interest. Obviously, they are just opinions, and some of them are political opinions, and they are his and his alone. He was asked, "You've written a lot about the geopolitical recession, which isn't an economic term," and he said, "What's going on today?" So he's written a lot about a geopolitical recession. We're not talking about an economic recession, but a geopolitical recession. And what he said is, geopolitics, like economics, is cyclical. People don't recognize that because geopolitical cycles, meaning sort of the macro changes that are taking place in politics, the broad view, take place over a much longer period of time than do economic cycles. And he said, we've had a very good run of U.S.-led global institutions like the G7, reflecting a new world order after World War II. And he says, whether we recognize it or not, because we're in the midst of it and aren't viewing it with the benefit of a history book, he says that those institutions are unwinding. And we're entering a period where the institutions that we currently have in place increasingly don't work, and we're at one of those inflection points where the world is going to need to build new institutions, and not the ones that were built post-World War II. He also talks about the changes that are taking place as the result of technology, and I thought he had some interesting opinions or insights. And what he's saying is that up until a few years ago, that technology was a driving force in undermining authoritarian states, and the revolution of the internet was very destabilizing to authoritarian or dictatorial regimes, as new information was entered into those countries that had previously been censored. And what he says is that in the second phase of the age of information, the age of big data, these authoritarian regimes are better able to filter and control the information now that there are new tools available. And he says that those changes, like surveillance and the ability to influence social media, these things, he said, make the U.S. weaker and more divided, and make China and other authoritarian states stronger, which he says was exactly the opposite from the technological advances achieved 10 years ago. When asked about the U.S. presidential election, who wins, he says, I don't know. He says the impeachment issue is serious, but he says that if the Republicans in the Senate were to vote for impeachment, he said that they would basically be giving up their any chance of winning the 2020 presidency. So he thinks that that's an unlikely event, although he said he thought that the probability of that not too long ago was about 1%, and now he thinks that the probability of that is somewhere in the 10 to 15% range. When asked about the Democratic nominee, he said not Biden. He says now that Warren is a front runner, there will be a lot of money against her. So he says it remains to be seen if a centrist candidate who sort of is the post-Biden candidate in his view is able to wrest the nomination from Elizabeth Warren. When asked about the Middle East, interesting perspective here from him, because this is before the raid over the weekend where the ISIS leader was killed. But when asked what happens in the Middle East as the U.S. steps away from Syria and tries to counter Iranian aggression, he says that foreign policy establishment and the U.S. Withdrawal of troops from Syria, he feels, has been overstated by the media, because the establishment, both in the State Department as well as in the media, he says, hates everything about the Trump foreign policy. He says the Syrian war was lost under President Obama. He says that happened for legitimate reasons. The U.S. didn't have a strong interest in Syria. We weren't willing to fight another war there, and that's why Assad was able to remain successful. He says regarding Iran, his view is that Trump recently, he said, was absolutely unwilling to support the Saudis who wanted to strike the Iranians with airstrikes after the Iranians attacked the Saudi oil fields. But he said that President Trump doesn't want a war. And what he says, what President Trump at this point, and again his opinion, really wants, is he wants to have talks with Iran like he did with North Korea. And he wants to get a deal done with Iran. He said, and that deal probably wouldn't have to be and probably wouldn't look like a very different deal than what the Obama administration worked out at this point, but something nominally different that he could point to and say that a deal was struck. With China, he thinks it's unlikely that a deal will ultimately happen despite the recent positive headlines. He thinks that it's possible a limited deal could be struck, but he says that if you trace the negotiations and where we are today from where we started, he said not a lot has changed. He said that President Xi has largely given up on the negotiations, that he has lost the confidence and his trust for President Trump, and that he's expended a lot of political capital within the Chinese government trying to get a deal done, and he hasn't gotten anywhere, and it hasn't helped him politically. So he feels that President Xi will wait until the presidential election to see who the next president is, and if it is President Trump, then perhaps he will negotiate with President Trump, and if it's another candidate, perhaps he'll negotiate with them. But his feeling is the Chinese will wait for any meaningful change on trade. So some interesting viewpoints. Moving on to Barron's, and Barron's did a poll of big money managers for 2020 and to get their sentiment and opinion on the markets. And the interesting result is that money managers are the most bearish that they've been. This is not individual investors. This is money managers in over 20 years. When you look at the outlook for the next 12 months, 31% are bearish, 27% bullish, 42% neutral. You may say to yourself, well, that's great news because the counterintuitive argument holds. That's more typical, Barron's points out, for individual investors, not institutional investors. Institutional investors, not quite the contrarian indicator of retail investors. In fact, over the last several years, institutional investors have been quite bullish, and as we know, the markets have done very well. Taking a look at a couple of the other opinions that came out of this. When will the next U.S. recession arrive? The most common answer was 2021, with 33% of respondents stating that. 10-year Treasury 1 year from now, interesting. 40% said basically the 10-year Treasury would be lower than it is today at 150, and 14% even said 1% or less. So 54% said the 10-year Treasury will be lower yielding than it is today. 31% said it'll be yielding 2%, and 15% said 2.5%. Virtually no one predicting 3-4% Treasury yields. Of course, time will tell. How likely is that we'll see negative interest rates? 79% saying that is unlikely to very unlikely. Interesting, among the Democratic candidates for president, whose policies do you most favor? Joe Biden, the clear leader among money managers, 61%, Pete Buttigieg at 13%, and other candidates very negligible in terms of liking their policies. In terms of who will be the Democratic nominee for president, 64% of them said Elizabeth Warren and 31% said Joe Biden. Who will win the next presidential election? Big money managers saying President Trump will be the winner, 62%. Which candidate will you prefer to win the election? Interestingly, 42% said President Trump. Number 2 is Joe Biden at 25%. Money managers divided evenly on approval of President Trump's tariff policy, 50-50. When asked what should Congress's top priority be regarding health care, overwhelmingly 72% said that we should reform the Affordable Care Act. Very few saying we should repeal it or we should repeal Obamacare. So thought that was also interesting. One article on an individual concept or stock concept, and then talk a little bit about some fixed income ideas. Barron's talked about 5G, and I know I've had a bunch of clients ask me about 5G and what it means for investment and where the opportunities are. Barron's pointing out that there's a lot of tumult, as they call it, going on with 5G. Just this past week, network equipment maker Nokia slashed its profit forecast, citing its need for additional investment to keep up with the intense 5G competition. The stock tumbled 23% on that news, as well as news that they were cutting the dividend in order to invest more in their business, and the market's not viewing that favorably. Also interesting on 5G in this article in Barron's, Goldman Sachs analyst quoted saying that Goldman does not believe that 5G offers consumers much in the way of additional utility. What do they mean by that? They mean that a lot of the high speed that consumers seek, they are currently getting in the Wi-Fi world, and lots of the opportunity from 5G in terms of that increased speed is being felt by the consumers already through their Wi-Fi network. So the Goldman analyst suggesting that perhaps the hype is somewhat overblown. Also interesting point from the Goldman analyst that over the past 9 years, the data consumed per wireless device has increased 89 times. Revenue per device has dropped 12.6%. So something to think about with the coming of 5G, that the carriers, at least so far, have failed to extract any additional revenue from that additional data consumption. Now, the article is not saying that 5G is a bust, just that it may not play out the way that the experts anticipate in terms of what is going to or not be the best investments. The article concludes that perhaps the place to best capture the benefits of 5G will be in the chip makers that are being called upon to produce more advanced devices. And the article talks about Qualcomm. They quote the Qualcomm CEO saying that a lot of people don't have the frame to know that the 5G rollout is going very quickly, not here in the United States, but in China, he says. 100,000 5G base stations are going to be deployed in China this year, and next year, he says, 1 million base stations will be deployed in China. He talks about Qualcomm getting a double win from 5G. They are going to have an increasing number of components in 5G phones. And he says that Qualcomm gets 1.5 times as much revenue on average from a 5G phone as from a 4G phone. Also, he said one trend that they see at Qualcomm, which I thought was interesting, is that corporations are establishing 5G networks, particularly in Asia, to replace Wi-Fi networks. Again, this is something that's being done on a corporate level, not ready for home use. But saying that there's a lot more technology bells and whistles that could be put around 5G that Wi-Fi routers can't currently support. And this is a positive, obviously, for the companies that make these base stations to support these Wi-Fi replacements of 5G. Finally, last thing I'm going to mention, Barron's talked about closed-end funds getting a fresh batch of new issues for closed-end funds, and they're different than closed-end funds had been in the previous decade. So what's going on in the closed-end space? So far this year, there have been 6 new funds totaling $3.6 billion. That's up from $350 million last year, so 10 times more closed-end funds being offered this year than last year. New issuance of closed-end funds has been low for a number of years previous to this year. Reasons for that is traditional or existing funds traded at a large discount, 10% or more to net asset value, which made it very difficult to come out with new funds that trade around net asset value. Also, big changes in the way the closed-end funds are issued. The old way of issuing closed-end funds worked against investors. Underwriting fees, including sales commissions to financial advisors, were paid out of fund assets. So, for example, a fund came out at $20 a share, but the net asset value was immediately $19.20 per share. These new funds that have come out this year take a different approach. Sponsors have paid the underwriting fees so that a fund issued at $20 starts at $20. So it comes out at $20 a share, and the NAV is $20 a share because the fund sponsor is paying the advisors to help them distribute their funds. Another plus is that this year's funds are due to terminate or give investors the option to redeem shares at net asset value in 12 years. One continuing issue with closed-end funds is that the fees do remain high by traditional standards, often averaging more than 1% at a time when investors are cost-conscious towards those fees. 2 funds I'll mention that came out this year, not recommendations, just these are the 2 that are trading at the largest discount to net asset value from where they came out. One of which is the PIMCO Energy and Tactical Credit Opportunities Fund. The symbol is Nancy Roger Golf X-Ray. This PIMCO fund owns MLPs and other energy infrastructure companies and energy company debt. Before this article was written, it had a yield of 9.5%, was trading at a discount to NAV of about 4.5%. The management fee is 1.35%, and the assets of that fund are about $710 million. The fund trading at a wider discount is the $236 million Tortoise Essential Assets Income Fund. The symbol there is Tom, Eddie, Apple, Fox. This is an unusual hybrid combining energy infrastructure, stocks, and bonds with socially responsible investing. What is that? Loans to charter schools and senior care centers and sustainable investing like renewable energy. Investors not won over yet. Perhaps the complex structure is something that has been a turnoff. The shares are down about 20% since the fund's inception in March and traded about a 14% discount to net asset value, and they yield 8.3% there on TEAF. The management fee there is about 1.5%. That's everything I've got.
Thank you for listening to Mr. Keith Lanton. For more podcasts, please visit our website, www.lanternwa.com.